The dollar's share of global reserves fell from 63% in 2000 to 40% in 2025. Nobody's talking about what that means. When you fill your tank, in 3 minutes, you'll discover why the petrodollar system that subsidized your lifestyle for 50 years is unraveling, how China and Russia are settling 90% of their oil trade without dollars, and what happens to your mortgage rate when the world stops needing greenbacks to buy crude. I'm Mark Roach, petroleum engineer, deal maker, 30 years of deal making and drilling and operating and doing petroleum engineering business, advising billionaires and powerful entities around the world, all over the world, 6 continents. Well, this is FutureWise Energy, and this is an independent analysis. This is not sponsored by anybody. Now, today, WTI is sitting around 58.42 a barrel. Brent, 63.58, both down 22% year over year. But the real story isn't price. It's what currency that crude trades in and who controls the system. Now, in 1974, Nixon and the Saudis cut a secret deal. Saudi Arabia would recycle oil revenues into the U.S. Treasury securities. America would provide military protection. Now, that arrangement created artificial global demand for dollars, keeping U.S. borrowing costs artificially low, and gave Washington the exorbitant privilege of printing money the world was forced to hold. Economists estimate that this privilege saves American households $50 to $100 billion annually through reduced interest cost alone. So you've been living off this subsidy your entire life without knowing it. Your cheap imports, your low mortgage rates, your government's ability to run $37 trillion in debt without a currency crisis, all built on one foundation. The world needed dollars to buy oil. That foundation is cracking. Russia and China now conduct 90% of their $244.8 billion in bilateral trade in yuan and rubles. India buys Russian crude in rupees. Saudi Arabia, which insisted on dollar-only payments for 50 years, now accepts yuan from China, its largest customer. Iran takes yuan. Brazil and China settle in local currencies. The shift is structural, and by the end of 2024, roughly 90% of Russia's trade with BRICS, B-R-I-C-S partners, was settled in national currencies. Now, China completed its first LNG trade in yuan on the Shanghai Exchange. The Petro-Yuan futures contract provides a genuine alternative to dollar benchmarks for the first time in history. If current trends continue, analysts estimate the petrodollar could lose 60% of its share in global oil trade. That's approximately $1.62 trillion in annual transactions at $100 per barrel prices, proportionately less at current $60 per barrel levels. But the structural shift remains. The expanded BRICS bloc now includes Iran, Saudi Arabia, UAE, Egypt, Ethiopia, and Indonesia. This grouping controls 42% of oil supply and represents over 45% of global GDP at purchasing power parity, and explicitly pursues de-dollarization as a policy. They're building the BRICS Bridge, a cross-border payment system designed to bypass SWIFT, S-W-I-F-T, and process transactions in national currencies using blockchain. Pilots run through 2025 to 2027 with full operation potential by 2030. The system faces formidable obstacles. Integration complexity, political divergences amongst members, economic asymmetries, intense Western pressure, threatening secondary sanctions. Imagine that. Financial experts at the Atlantic Council and at the Peterson Institute dismissed the threat, stating the dollar remains the leading reserve currency and BRICS pose no serious challenge. They cite network effects, institutional inertia, deep liquid markets, rule of law, and decades of integration as advantages that can't be replicated quickly. Well, they're right that full displacement is distant, but they're missing the incremental erosion that's already happening. ING Bank shows dollar-denominator cross-border lending by core BRICS residents declining from 67% in 2016 to 55% in early 2024. That's not revolutionary, but it is directional. The Venezuelan intervention crystallizes this dynamic. On January 3rd, U.S. Special Forces captured Maduro. Trump stated America would run Venezuela and U.S. companies would seize Venezuelan oil to sell on the open market. The timing matters. Venezuela had deepened ties with China, which controlled over 90% of the rare earth capacity and financially supported PDVSA. Iran established drone facilities there. Russia sent military advisors. The operation aimed to prevent strategic competitors from consolidating influence over the hemisphere's largest reserves, 303 billion barrels. Now, Secretary of State Marco Rubio articulated that the strategy, he articulated it bluntly. If we control the flow of oil and the cash from those sales, we have large leverage. Well, that's indefinite control over Venezuela's primary economic asset. Energy Secretary Chris Wright reinforced this at Goldman Sachs, stating control and leverage drive the changes that must happen. But here's the paradox. The more aggressively America weaponizes dollar dominance, the more force that it uses, the more urgently other nations work to escape it. Freezing Russian reserves, cutting countries from SWIFT, seizing Venezuelan assets. These demonstrate both the extraordinary power of dollar dominance and the acute vulnerability of depending on dollar systems. Countries fearing future sanctions have powerful incentives to reduce dollar exposure regardless of economic efficiencies. Trump threatens 100% tariffs on BRICS nations in December if they pursue alternative currencies, telling them to say goodbye to selling into the wonderful U.S. economy if they don't commit to dollar supremacy. That coercion may slowly de-dollarize short-term, but it validates the concerns driving it and likely accelerates long-term efforts to build alternatives Washington cannot control. For the average American, here's what matters. The dollar's reserve status directly supports your living standard in ways that are invisible until they're gone. It allows America to import more than it exports without currency collapse. It keeps borrowing costs low for mortgage, cars, government services. It means the rest of the world subsidizes American consumption. De-dollarization erodes those advantages gradually. A weaker dollar makes imports more expensive, hitting household budgets for fuel, food, consumer goods, anything manufactured abroad. It forces the Federal Reserve to maintain higher interest rates to attract foreign capital, making borrowing costlier. If foreign central banks reduce Treasury holdings, the U.S. government faces higher costs to finance debt, potentially requiring tax increases or spending cuts. One analysis described the scenario starkly. This would shock the United States economy with massive price increase on consumer goods while crippling government. Well, because deficit spending will no longer be possible if no one buys the debt. Well, that's extreme. But the direction is clear. Reduced dollar dominance means reduced American economic privilege manifesting as persistently higher inflation, reduced wage purchasing power, more expensive foreign travel, and diminished ability to finance government programs through debt rather than taxation. The transition will be gradual, measured in decades, not years. The dollar still accounts for 58% of global reserves, dominates bond issuance, remains predominant for invoicing trade, even between non-US countries. China's yuan faces structural obstacles, capital controls restricting free movement of funds, underdeveloped markets lacking depth and liquidity, political system offering little institutional independence, creating investor concerns about government interference. These can't be overcome through political will alone. They require fundamental financial reforms Beijing shows little appetite to implement. Network effects create tremendous inertia. Businesses worldwide hold dollar accounts, price contracts in dollars, maintain dollar debt because everyone else does. Financial institutions built decades of infrastructure and expertise around dollar transactions. Even nations pursuing de-dollarization move cautiously because abrupt shifts trigger currency crises or instability in their own economies. The trajectory is toward multipolarity with multiple reserve currencies coexisting, dollar, euro, yuan, potentially others, rather than sudden dollar collapse. JP Morgan notes, de-dollarization will be gradual, measured in decades. But gradual doesn't mean painless. Every American energy independence provides some insulation, but that American energy independence that is getting some insulation from this. Well, the U.S. produces 13.8 million barrels per day, near an all-time high, despite only having 412 rigs running now. It's down from 70 a year ago. Domestic production means less direct vulnerability to oil supply disruptions or currency manipulation than in previous decades. So the shale revolution transformed energy security fundamentally. However, oil remains globally priced. U.S. consumers feel international price movements regardless of domestic production. When global prices rise due to geopolitical tensions or supply constraints, gasoline prices increase correspondingly even if America exports more than it imports. More fundamentally, dollar dominance benefits extend far beyond energy into all trade, finance, government borrowing. Losing reserve status impacts American living standards, whether or not the U.S. produces its own oil. The Venezuelan intervention illustrates this. Despite robust domestic production, the Trump administration considered access to Venezuelan reserves strategically vital enough to justify military action. That reflects awareness that controlling global energy flows and the currency they're denominated in confers geopolitical power beyond supply-demand calculations. Current energy markets show abundant supply. OPEC Plus confirmed production unchanged through Q1 2026. The IEA projects potentially surplus exceeding 4 million barrels per day throughout this year, 2026. Goldman Sachs predicts that Brent will average $56 a barrel in 2026, and WTI will drop to 52 on average this year, with the logic being that global crude supply surplus patterns will remain unchanged from what they are right now. U.S. crude inventories drew 2.8 million barrels in the week ending January 2nd. Strategic petroleum reserve levels rose 300,000 barrels to 413.5 million as Trump replenished depleted stockpiles. Gasoline and distillate inventories saw substantial increases, gasoline gaining 4.4 million barrels, distillate rising 4.9 million, suggesting weaker than expected demand. The M&A landscape saw extraordinary activity over the last couple of years. U.S. upstream deals surged 331% to about $207 billion, driven by ExxonMobil's $60 billion Pioneer acquisition, Diamondback's $26 billion Endeavor purchase, ConocoPhillips' $22.5 billion Marathon acquisition. This consolidation reduced top publicly traded E&P companies from 50 companies to 40 companies, creating fewer but stronger players that are better capitalized and more efficient. But M&A cooled last year, and amid the volatile commodities, equity swings, constraints, including lack of attractive targets to acquire, especially in the Permian, the currency in crude is purchased and matters profoundly because especially in the Permian. The currency in which crude is purchased matters profoundly because it determines which nation finances deficits easily, which currency central banks hold in reserves, which financial systems process trillions annually, and ultimately, which country possesses the exorbitant privilege of printing money the world willingly holds. For half a century, that belonged unambiguously to the United States through the petrodollar. Erosion of this system represents one of the most consequential geopolitical developments of the 21st century, with implications touching every aspect of American economic life. Your standard of living has been partially built on dollar dominance that can no longer be taken for granted. The ability to run persistent deficits without consequence, to borrow at artificially low rates, to purchase imports at discounted prices, to wield financial sanctions as foreign policy tools. All these flow from reserve status that's gradually eroding. The transition will unfold over decades, punctuated by crisis, but lacking single dramatic collapse. You may experience this as persistently higher inflation, reduced purchasing power, more expensive imports and travel, fiscal constraints on government, as deficit financing becomes costlier. Extent and speed depend on policy choices in Washington. Whether America maintains institutional credibility, avoids excessive deficit spending, preserves rule of law making dollar assets that make them attractive, and navigates tensions between using sanctions as leverage and accelerating de-dollarization through their use. The energy sector provides a microcosm, with OPEC holding production steady and amid oversupply. U.S. producers demonstrating efficiency despite reducing rigs, and major oil flows increasing denominated in currencies other than dollars. The market simultaneously grapples with near-term supply, demand fundamentals, and longer-term structural transformations in global financial architecture. The January 2026 Venezuela intervention represents an attempt to reassert American control over hemispheric energy resources in a world where that control can no longer be assumed. The essential insight: the currency of crude matters because it determines the currency of global power. As that shifts from unipolar dollar dominance toward multipolarity, Americans adapt to a world where economic privileges of the past half-century gradually diminish. The transition won't be immediate or catastrophic, but long-term implications for American prosperity and the geopolitical influence are profound. Understanding, these dynamics may be the first step toward navigating the more complex and competitive global economic landscape ahead. The system that subsidized your lifestyle for 50 years is being rebuilt, not overnight and not without resistance. But the direction is set. Your purchasing power, your borrowing costs, your government's fiscal flexibility are all derivatives of a petrodollar system designed in 1974 that's being systematically dismantled by nations seeking to escape American financial leverage. That's not an opinion. That's an observable market behavior reflected in reserve composition, trade settlement patterns, and infrastructure investments spanning continents. So the question isn't whether this transition happens, it's how fast, how disruptively, and whether American policymakers, listen up, recognize that weaponizing the dollar accelerates the very erosion they seek to prevent. Reality doesn't negotiate. It adapts. Your standard of living adapted upward for 50 years on the back of a system most people never knew existed. Now it adapts to a world where that system loses its monopoly. Position yourself accordingly. Understand the structural shifts. And recognize that convenience built on geopolitical dominance eventually faces a reckoning when the dominated find alternatives. I'm Mark Roach, and this is FutureWise Energy.